Hey guys, Yields here. So we're gonna be looking at the portfolio again today. So yeah, basically jumping straight into it. Like I said, last week I was going to add in some funds for the month. So I went ahead and actually chose 2,000 for this month. We're gonna try to do 2,000 every month from here on out. Hopefully over time we can just start to increase that, but as it currently stands, $2,000 is pretty feasible, and it gives us a little bit of buffer room. That is a lot of savings still, obviously. So yeah, we'll see. Hopefully you can increase it. I think we'll be able to manage 2,000. Worst case scenario, we have the option now, we just go lower, but we're going to be aiming towards 2,000. So jumping into this last week, we can see here just under 0.95% down, so almost 1% down, which equates to about $93, which obviously sucks. But if we jump over to the S&P 500 portfolio, that is down 2% this last week. So I'm pretty happy with that, right? So we're basically safer this week than we were last week. Sorry, this week with our portfolio than the S&P 500 was. So yeah. So yeah, we can see here that we're still above the S&P 500 portfolio by about $341, which equates to about 3%, and we're above our amount of money by 6%, which isn't a lot. I know that, so I'm planning to make some changes here soon, but I'll dive into that a little bit later in the video. I got I saw something on another YouTuber's channel. Let me pull it up here for us. So Dividend Dashboard is the person I was watching. I think it was this video. I kind of liked one of the screens he had on there. So let me see if he has it. I think it was a few back here. Yeah, this screen I kind of liked. So I'll leave his channel out in the description for you guys to go visit. But I like this screen because it gives a nice overview of the page, or of his portfolio. So I kind of made that. So currently our portfolio is worth $11,729. Our annual dividend, this is basically just the last year of which we earned dividends. We've earned about $1,200. So technically that's only up to July, since that's when we started this portfolio. The dividend percentage is 24%, 24.7%, but that's a lot of that is brought down because we have TQQQ and BTOL, which have a very, very, very low percent dividend. They do have dividends, but they have very low percent compared to YMAX. So that YMAX dividend is brought down a lot. And we have 3 holdings, so the TQQQ, BTOL, and YMAX. And then you can see 1 week, 1 month, and then 3 months, and a year to date. I think this 1 week kind of looks wrong, so I might have to fix that because obviously we know that we lost money this week. I think actually what I might be doing is taking the sum of these two values, which if you do that, that's 112. Yeah, so that's what's going on here. I'll look into that, but that's, yeah. Anyways, we can see here that honestly, not the best performance if you look at the last 3 months. And especially year to date, we've just been dropping a lot, but we are still above the S&P 500, which is nice. That's just kind of something we're gonna have to deal with. So yeah, I already mentioned that I'd be earning the dividends this week earlier in my other video, but I'll go over that as well as some of the funds in this portfolio. So we earned $60.86 from YMAX, and I've recorded that in the income tax sheet as well. That was for testing purposes, but you can see here, so far in 2025, we've earned about $376 in just, gross income. So not terrible. And yeah, we had 3 buys as well. And then if we go into the I think that's if we wanted to go into this, you can see we lost a lot in on our WiMAX portion of the portfolio. We lost about $180, which is 3.43% down. And then on the QTOL side of the portfolio, we lost 1.48%, which is $79. So yeah, you can see how that kind of lays out here. Moving on to the Webull portfolio, we are up obviously with the MSTR. I pull up here. If we go to last week, it's down 7.88%. So this is actually really nice that we have this kind of kind of the setup with our portfolio. With WiMAX, it goes down because it has the MSTR or it has Misty, right? But with this, we obviously have the opportunity to go back up. So this is pretty nice. And I've been saying this for a while, but I think MSTR is going to start heading downwards, hopefully. I mean, I know I've technically made that bet about like a month or 2 ago. Or I don't know how long it's been at this point. Let's see. Yeah, a few months. That's all we know. It is a few months. And that obviously panned out pretty bad. At one point, we were down $700, but we're getting back up there. We're about $358 down, which is not terrible, considering where we came from. And I think this is going to keep going up, so that's really nice. Hopefully, that doesn't take a huge toll on WiMAX. That's one of the biggest fears I have. But, as far as the things I was mentioning earlier with the potential changes that I want to make to the portfolio. So one of the things I've been talking about recently is actually getting into AIPI. So if I look here, AIPI, and we do the charting against WiMAX, one of the things I've been showing is this chart. Recently, AIPI had actually a really bad week. I think it was this last week. So this is total return on the last 2. So if we go to year to date, AIPI is actually down, or it's almost, it's up 1%. Where WiMAX is up 2.28%. But you can see here, it's actually above WiMAX, a week or 2 ago. At some point, not by much, but it was up, and now it's down quite significantly. After the 18th, it went down quite a bit, right? So it had about 6% up for the year, and now it's down 5% from that about. So that really sucks. In the last week, you can see it's down 5%, whereas WiMAX is 4.14%. So man, it's kind of hard to say. Like, I wanted to show, I'll show a picture of the stock market as I saw it on Friday. This is a picture I took of the total, just the heat map, I think is what they call it. So I'll show that right now. So you can see here, it's like pretty red, right? The green areas that I can really easily see are utilities, obviously. We also have consumer staples. It's another one that I see did decent. The main ones, I mean, every other market's pretty much completely red. Utilities, like I said, did really well. I actually don't see any red in there. Whereas consumer staples, I think at Walmart and Costco down a little bit. But other than that, that's mostly green. Actually, healthcare was also green, but mostly every other market is pretty bad, right? So This obviously explains a lot that happened in S&P 500, and frankly, a lot of it is reliant on the, AI with AIPI. A lot of it's reliant off of the tech stocks, which you just saw in that picture that it's mostly red, so it's obviously not going to do very well. Now, that same thing is true technically about WiMAX. It's mostly, it is mostly tech stocks, but I think maybe it performed just a bit better. Like, it went down 4% this week, right? That's still terrible. But I think it probably just went down less because it has less concentration in that. So this is something I was worried about with AIPI, is just, yes, the dividends are very stable, but that's the problem, obviously, with the the NAV, is it just might tank because it's so concentrated. So if we could have obviously some kind of 35% option, equivalent to this, that'd be great. If we could have, what was it? FEPI, not FIPI, FEPI. This is the innovation fund, right? I think this one is, it's the other competitor, or it's not a competitor, but it's also from Rex. So if we come over here to holdings, you can see it's 68% technology, with communication and consumer cyclical being the next two biggest categories, whereas AIPI is 91% technology. So there's definitely more concentration there, right? So, and we can see the holdings here with FEPI, largest being Palantir, Intel, Netflix, whereas on here we have on AIPI we have Palantir, CrowdStrike, and this is the one that probably killed it this week, which is 10% almost in NVIDIA. So that is something that obviously we have to keep in mind. Now, there are other funds, XDTE, that's going to be, pretty decent. If I pull up my calculator here, and go over to XDTE, we can pull that up here. The only problem is, last time I looked at this, it's not as stable as AIPI or FEPI. If we look up at FEPI here, FEPI averages out to about 27%. According to this, I think it's actually 25%, and then AIPI is 35%. So these are really stable, right? Like, you can see the annualized yield is like a straight line, which is very convenient for both of these. With XDTE, on the other hand, it's a little bit more jaggedy, especially with that random 40% in there, which is not bad. It's just like, it's hard to, see this. And you can see the trend here. So we have a slight downtrend here with FEPI, slight downtrend, and with AIPI, pretty much the same price, but like technically a slight downtrend as well. What I'm trying to say is, I don't know. There's obviously not a perfect fund. XDTE would be close, in my opinion. It's just obviously not super duper stable and has a lower yield than both of these. So, yeah. But it's doing options on S&P 500. It's doing 0 DTE options on the S&P 500. And the new competitor that just came out, I got to actually add that to my thing, is SDTY, which I also find really interesting. I think they just paid out their first dividend. I did a video on this, so I should know. But yeah, they just paid out their first dividend. And this is a weekly payer. So I don't know. The thing is, okay, we can actually do a little bit of an analysis here. With the last week, it's 2.5% down, whereas XDTE is 2% down. So there's that. But I digress. I'm mumbling or whatever a little bit more. Another thing I've been talking about for a while, and I think I'm really going to take action this week, is getting rid of these two, and potentially just either putting in another income fund, because technically these are only generating us a little bit of capital appreciation, if that. If we actually go to holdings here, according to this, we're down. Well, actually, we're up about $50. $50. So we either do that, or so if we put in a new fund here that's, potentially some fund that gives us income like AIPI or XDT or something, we can get more income, obviously. I'm not super worried about income, obviously, because we're not using these. We're just using drip. The other option I've been really thinking about is really just going something completely super duper safe. And I don't know if I mentioned it last week, but the biggest one I'm looking at right now is SCHG, probably. Or there was a competitor that I forgot that I was looking at. But this is probably what I'm looking at. So if you go to Testfolio, this is one of the, this is like a favorite website of mine. Let's do an update. If we do a Testfolio thing here for SPY versus SPHG or SCHG, sorry, and set this to equal as well, and then just do a back test. Well, another important thing is, let's say we're doing $2,000 every month, starting with $10,000, all the way back, starting in 2009, and then we can see here that the CAGR for SCHG is bigger. The drawdown is very similar. Yes, there's a little bit more volatility, but not by much. And if we do the annual returns, we can see here, most of the time, it is actually pretty amazing. Like in 2023, it was 50%, which is crazy. Last year was 34%. So obviously, you're going to have more down years, but even this in 2018, the S&P 500, or like SPY, was further down than this, which is actually really intriguing. If we do the last, maybe the last 5 years, let's do like 0101 2020. I know this isn't exactly the best way to look at it, but it's something. We can see here that the CAGR is 19%, which we can see here as well, and the annual returns are here, right? 37% compared to 17%. The only year that really got this dead was 2022. And if you ask me, I think 2025 is going to be a good year for SCHG, because SCHG is largely a large holding, or it's large cap growth, right? Which, with the changes to the rate cuts and stuff, small businesses aren't going to be seeing a lot of growth anyways. So having that kind of large cap growth ETF under our books could really help. And if we look at the last year to date, it's only up about 0.5%, which we can compare that to, sure, the S&P 500, or let's just do SPY more specifically. It is not doing as good technically, but it just gives us the opportunity, right? So again, here we've seen only a single year, 2 years technically, where it's down beneath SPY in the last 5 years. But even 2021 was very close. My point is, if we could average 37% or whatever, close to 30% a year, that's still really good, in my opinion. And that's kind of what I've been trying to average out with these other funds. The reason I personally use high yield dividend stuff is because they do have a relatively stable, I guess it kind of depends on what you look at, but it gives you an idea how well the fund is doing over time, as well as it is kind of fun, right? Like it's fun to invest in these funds. And it also gives me more practice for what I'm going to rely on this in the future. So, but anyways, I digress. I would like to, I'll end the video here, and I will get this out for you guys, but we'll see what happens to the funds. I mean, obviously it's going to be a taxable event when I kill these, but it's not like we have $1 million in each of these. It's not like we've honestly gained a lot of money, $50. So it's not the end of the world if we do choose to sell TQQQ and BTOL. It does kind of suck because I was going to plan on, I was planning on doing this for a while. In fact, I can show you real quick. I know this video is going on for a while, but if we make another portfolio and we do actually allow that TQQQ, I actually might have it saved here. TQQQ BTOL. So it's 50-50, which is what we have. And we do here, and we go to summary. You can see, according to this, it would perform very well. So maybe, I don't know, man. It's really hard. Looking at backtests, you can get lost in the numbers so easily. But when you actually feel and go through the actual portion of the like when you see the numbers every week or every day move up and down, it really does. It's hard. It's hard. We need to be able to stomach these. So it's still a decision I need to make. Like 2025 or 3 was a 91% year with this setup, which 2022 was actually, it was less than SCHG in terms of loss. So, it's one of those things. In fact, this is actually doing better than both of these this year. So maybe it's something we keep. I don't know. I got to do more thinking on this, because obviously this is, I want, another reason I should get into this real quick is I'm thinking more and more about using margin. And if I were to use margin, first of all, the margin requirement is a huge thing, right? So if I come over here and I go to TQQQ, the margin requirement for that is 75%, which is huge, right? But if I go over to something like SCHG, on the other hand, we can see that the margin requirement is 25%, which I think is the lowest they can actually put on a fund. So I could be using this as the core of my portfolio, and that's something that what's his name? Not an investment guru, I think. Michael, I think is his name. I mentioned him in a previous video, but that's what he does. He does it with XDTE, I believe, but actually his core fund, I think, is maybe Tesla. But regardless, he uses, I think, XDTE as the ability to borrow against it as well. So it's something we gotta keep in mind as well. But anyways, this video is pretty darn long, so apologies for rambling so much. But yeah, that is it for me. And as always, I wish you guys a wealthy future.